Enphase Stock is down 52% this year, and in order to determine if this stock is a multibagger, which means that a $10,000 investment turns into $1 million, we are going to look at the financials of the company, the balance sheet, and use my Excel spreadsheet to see what price you should pay for the stock. Starting with the financials, one of the most important aspects of a multibagger is growth, and this company has it. Over the past 5 years, revenue has grown at an average of 62%. However, analysts are expecting an average of 22% for the next 5 years, which is significantly less than the years prior, but still a lot of growth. And on the profit perspective, analysts are expecting this company to make $11 per share in 2027, which, if you assign a 20 PE, it would make it a $222 stock, which means 86% returns, which is a lot. Moreover, multibagger stocks tend to be in sectors that have growth potential. In this case, solar energy is expected to grow at a 15% compounded annual growth rate until 2030. This company is also growing net income and free cash flow. Net income was negative 5 years ago, and the trailing 12-month net income is $527 million. And they have even more free cash flow, which was also negative 5 years ago, and it is currently at $865 million. Therefore, their margins are also very high, which is amazing. Gross margin is at 43%, profit margin at 20%, and free cash flow margin at 30%. And high margins are also very important for a multibagger. So far, the financials look very good, but the question becomes, can we pay a good price in order to make a good return on our money? In order to answer this question, we are going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers on the screen. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, that in order to make the desired annual return that I have put in, you need to pay those prices. Second, that if the low assumptions occur, you are going to make a 9% annual return on your money. If the middle assumptions occur, 20%, and if the high assumptions occur, around 30%. This means that if the middle assumptions occur, you could get a multibagger in 25 years. And I think my middle assumptions are very probable. As I have the company growing at 16% annually, keep in mind that analysts are expecting 22%, with 24% profit margin, which is currently at 20%, 28% free cash flow, it is currently at 30%, and assigning a 20 PE and price to free cash flow to the company. The forward PE is currently 22 and the current price to free cash flow is 18. The desired annual return is very important for a multibagger. I have put in 20% because this means that it would take 25 years in order for it to be a multibagger. One thing you need to understand is that the key to a multibagger is patience. You need to let growth compound. One thing that I don't like about the company is shares outstanding. They have increased their shares by 40% over the past years, which is a very bad thing as you own 40% less of the business. By doing nothing, you have been diluted. However, in their quarterly report, they announced a share repurchase plan. So this is why I left the share outstanding change at 0%, because the future regarding this aspect is unclear. Also, the Excel spreadsheet does not address any value to the balance sheet, but this company has a great balance sheet as it has very little debt and net cash position of $506 million, which is amazing. Before giving my conclusion on the stock, I want to talk about return on invested capital, or ROIC. This is a very important metric for multibagger. It's a complicated metric and I won't get into the details, but just so you know, the market average is around 9 or 10%, and Enphase has a 23% ROIC at the moment, which is more than double the market average, which is amazing. Microsoft, for example, has 24%. In conclusion, we have a stock with a lot of growth potential, great margins, great balance sheet, and trading at a good valuation. I think it has the potential to become a multibagger because it could have a long runway. as the industry has a lot of growth and the company is small within the industry. The other side, the cons that I have found, are that the industry is very competitive. As the rates increase, we could see a fall for demand in solar panels and the uncertainty of shares outstanding. I also think this is going to be a very volatile stock, but it could be worth the gamble. I hope you enjoyed today's analysis. Let me know what you think about this company in the comments, and I'll see you on the next one.